Hello everybody, this is Rob Reinhold from Maverick Trading. Welcome to our Levered ETF series. In this session, we're going to be talking about the 3X Financial Bull ETF, also known as the FAS. But before we jump into the levered ETFs, we need to go over very quickly what an ETF is for those of you that don't know it. If you don't know what an ETF is, none of this is going to make any sense. So let's go over it just really quickly here. Whenever you hear the term the stock market, that really doesn't mean anything. Look, there's several different exchanges where stocks are bought and sold on a daily basis and they go up and down. There's really no way to say, hey, how are all the stocks doing? And so they created these things called indexes that you could actually track what the market was doing, like the Dow Jones Industrial Average, the Standard & Poor's 500, the Russell 2000. And they created these as a way for someone to look at this number and say, oh, the market went up today, the market went down today, but it was just a collection of those 500 stocks that they put in there. In 1993, a firm called State Street created the first exchange-traded fund called the SPY, or as was called the Spiders. This was developed to deliver the same return as the S&P 500 index. The great thing about these is it was a stock. It wasn't a mutual fund. It wasn't index. It could be directly bought and sold like a stock at any time at a really cheap price. This was a great alternative to mutual funds. Before ETFs, if you wanted to get the same return as the market, you had to pay a company probably somewhere around 0.5% or 1% to run the money to try to get you the same return. Now it's as easy as just buying SPY. And these have options, which is awesome. We're an options trading firm at Maverick, so we absolutely love options on these ETFs. We need to introduce you to a few indices first. The first index is the RIYFC. This is the Russell 1000 Financials Index. An index cannot be bought and sold directly. It doesn't exist. It's not a security. It's simply just a basket of securities people have put together and said, hey, we're going to track these baskets to give you an idea of how the financial sector has gone. So the RIYFC, you can see the largest position is Berkshire Hathaway, JP Morgan, Bank of America, S&P. So basically a collection of big banks and brokerages. Now, this is what the FAS had been tracking since its existence. But based on when you watch this, you may need to know a different symbol because effective August 1st, 2022, Directxeon has announced that they are no longer going to be following the Russell 1000 Financials. They're now going to be following the Financial Select Sector Index, which is the ticker symbol IXM. So this is the IXM index. And as you can see here, it's going to move up and down. But remember, you cannot buy and sell an index directly. You cannot do it. It doesn't exist. It's not a security. So what we need to do is we need to go find a security that's going to trade like the IXM. So we have to take our symbol that we want to track. And if a trader wants to get ×3 on this, they're going to take their multiplier to it. And that's going to give them the ticker symbol FAS. Now the FAS is the 3X Bull Financials. Directxeon is the company that runs this. And remember, these levered ETFs, they don't go in there and buy stock. Directxeon, what they're trying to do is they're trying to deliver 3 times the return of the IXM. That's their job. Now, they don't buy stock directly. They buy options, derivatives, futures, anything they can do to get this return. And remember, their goal is simply to get as close to 3X as humanly possible. If we take a look at the IXM on one side and the FAS on the other, you can see that they're going to move virtually in lockstep. When one goes up, the other is going to go up. When one goes down, the other is going to go down. Now, the FAS is going to be moving 3 times larger, but because of the scaling, they're going to look the exact same as the IXM. Let's talk about how and when to trade FAS safely, and not just FAS, but really any of these levered ETFs. One of the best ways to use them is in intraday or swing trading. We like to use these again, day trading, swing trading, really nothing more than I'd say 10 to 15 days. All of a sudden you're starting to get into some negative consequences. Let's take a look at a trade directly on the FAS stock. Here we are on FAS, and I'm going to be using this example as a way to do some short-term trading on this levered ETF. Now I'm going to do a little bit shorter term trade that I usually do. I'm going to go to a 1 hour chart, and I'm going to be using the bar replay feature in TradingView. This is an absolutely fantastic feature. We have other videos on how to use it. So all you do is go up here, hit replay, and then you basically will go back in time. Now I like to take my chart, stretch it out, and then just click on some random date in the past. Okay, and what that happens is this will take it to that date, and then you can basically hit the play button and then pause and then see what you would have done. So here we are, the FAS just opened up a new day and took a big gap down. Okay, so remember, these levered ETFs, you never want to go short them because there's typically an inverse long one that performs better. So we only want to be long this play here. So I'm going to wait until this FAS gets to be in an uptrend to where I have both moving averages going higher. Right now, they've flattened out, so there's still not a good trade signal here. I need these to be going higher and be steepening quite substantially. Okay, at this point, we now have the 20-period moving average steepening nicely, but check out our 50-period moving average. It is still basically flat. So it's telling us that yes, short term it's strong, but intermediate term, you still have to wait. Let's wait for that line to steepen. And you can see it never steepened. So we're just going to keep waiting on this. Remember, we only want to be long, so we're just waiting for an opportunity to where we have a good chart pattern and good trend signals for us. We might be waiting a while here as it looks like this FAS wants to continually move lower. But again, like all stocks, this is going to rebound at some point, and at some point we will have a buy signal. As you can see, we've started to flatten out again, which is a good sign for that's likely the end of this downtrend, but it doesn't say that it's in an uptrend yet. We need to see both of these lines steepen significantly. Once that happens, I'm very happy to take a look at a long trade, but until then, I am just not interested. Lots of weakness out there in financials during this period, as you can see. Okay, we're starting to finally now get some bullish price action. I want to see this 50-day moving average start to steepen more. Once that happens, I'm very happy to take a look at a potential trade long here. And you can see this thing does not want to go long whatsoever. As I said, this is a period of probably a lot of weakness in the financial sector. And again, this is on a 1 hour chart, so we've probably watched about, a total of 10, 15 days. All right, I'm going to start to pause it here. Now we're starting to get a little bit better price action. This 50-day moving average is not steep enough, but we're starting to get some pretty good signals that this down move is possibly over. You can see here, we've just kind of bottomed out. Take a look at the big picture. If we can break out above this line up here at 135.50, I'm going to go ahead and say, hey, you know what? That's the signal. I'm ready to go long. And frankly, I can actually go out and put a buy signal out there. I can put a buy stop at 135.50 that is automatically triggered. And we love to use these at Maverick. Just put these orders out there. If they get triggered, great. And remember, you're only going to get triggered if the stock shows some strength. Let's see what happens here. Didn't quite get to that line. Let's see if we're going to get to it. You can see this price action looks a lot better. Just a lot better here. We're getting a high base here. Let's see what the high here on this day was. The high on that day was 135.29. So we did not get triggered on that day. But this is good, strong price action. As you can see, that 50-period moving average is starting to steepen. Okay, so there was our fill. I'm going to go ahead and drag our fill over here. All right, so we got in at 135.50. Now, every short-term trade needs some sort of protective order. Stop order is the most basic of one. So let's go in and say, okay, I'm going to put a stop. And we like to use moving averages. So we're going to use that stop at the 50-day moving average, which is currently 131.22. And what we're going to do is we're going to use this 50-period moving average as its trailing stop. What that means is we're going to move our stop order as the moving average goes higher. And as long as it stays above this orange line, we're very, very happy to stay long in this position. So at this point, we're now moving up our stop order. We've now probably moved it up to 132. We're going to let this thing run. This is one of the biggest problems that new traders face, is that when they get a winner, they take it way too early. Remember, your job is you're going to make a bunch of trades. Some are going to be good, some are going to be bad. Some are going to be fantastic, and some are going to be absolutely horrific. No matter how hard you try, you're going to get a bell curve distribution. Your job as a trader is to hold the fantastic ones and dump the terrible ones as fast as you can. Everything else is going to sort itself out. But this is really where the game is won or lost. So we're going to let this thing go. As long as it does not go below that 50-period moving average, we are very, very happy to stay long. And we'll just simply be moving up our stop. We're moving up stops as this thing moves, letting it go our way. One of my favorite sayings at Maverick is that the best way you know that you're in a good trade is if you're profitable. I know that sounds kind of silly, but remember, if you're profitable, it means that the price action reflected what your trade was. So you actually got it right. Now, that can always change, but it's great that you got it right at the moment. So at this point, we've moved up our stop to probably somewhere around 140.50. This has turned out to be more of a swing trade than a day trade, but that's just fine. That's why we like to let these positions run their course. Once it goes down below that 50-period moving average, we're very, very happy to exit, take our profits, and go elsewhere. Again, we're going to be moving up our stop. So now our stops are moved up to 146.25. And as long as this continues to move higher, we're very, very happy to hold it. This is exactly what we want to be seeing on all these moving averages. Okay. So as you can see here, we got hit with a little bit of a gap. So we had our stop at 146.25. Well, let's say we'd moved it up to, 148, whatever. It doesn't matter because we got this gap. And this gap brought us down to this open price of 143.71. So that would have been the exit price on the morning. So exit 143, what did I say, 51? Again, it doesn't matter. Pennies aren't going to matter here in this example. 71. Anyway, let's say we got filled at 143.51. Our exit was 8 points above our entry. So this is about a 7.5% return, and it looked like we took this trade over, ended up being about a 6 or 7 day trade. This is how you can use this, and this is really how you should use these as a short-term trading vehicle. As you can see, the FAS is a great little trading vehicle whenever the financials are in play. But let's talk about the risks, because there are definitely risks to these leveraged ETFs. The first thing I want to talk about is the return differential. Remember, Directxeon is trying to deliver 3x return to the people buying the FAS. They don't always do it right. So if we take a look at December 2021, the IXM was actually basically flat for the month, plus 0.03%. However, in 2021, the FAS was down 2.2%. So what happens is you're going to get a little bit of a difference. Now, it almost always works against you. And if we take a look at the returns of the FAS and we compare them to the returns of the IXM, we basically need to say, okay, which one was better? We basically need to times them by 3 and get what's called the differential. I do have to say the differential on FAS is one of the best we've seen. Directxeon runs a couple of other levered ETFs, and they're pretty terrible, some of them. They actually do not track well at all. The FAS, they do a really good job, and you can see for the most part, you're going to be very, very close to the same return. Sometimes it's a little bit better, sometimes it's a little bit worse. So if you've been looking at other levered ETFs and you say, oh, I don't like how big the differentials are, I don't like to take, 3.5 times the risk for 2.5 times the upside, which is what a lot of the differentials work out to be. The FAS is really close to 3-to-1, at least it has been in the past. So the return differentials are always something to think about and to be worried about. And remember, the longer you hold on to these ETFs, the larger that differential is going to be. It's going to grow larger and larger, which is why we just don't like them for longer term holds. These also come with higher annual fees, right around 1%. Every time you get in and out of FAS, you better believe that Directxeon is going to be charging you a fee for that. Those are going to cut into those returns as well. So you've got the differential working against you. You got the higher fees working against you. If you think you're getting 3-to-1 on both your winners and losers, you're wrong. Like I said earlier, most of the time you're getting 3.5 times to 1 on your losers, 2.5 times to 1 on your winners. All of a sudden, you need a 60% win-loss ratio just to cover the costs of everything. And the other negative is there's really no benefit to trading options on any of these levered ETFs. The reason is the options market knows that these stocks are going to move 3 times larger than the ones they follow. All they do is adjust the options to be 3 times more expensive. There is no benefit, and actually there is a negative benefit of playing options on the FAS because these are not all that actively traded, which means you're going to have much wider bid-ask spreads, which again is going to be another expense that you're incurring. So let's talk about how do you trade options on the FAS. At Maverick, we are a strictly options trading firm. We're the largest options prop trading firm in the United States. And we love to use ETFs when we trade options, but it doesn't make any sense to use them on the levered ETFs. So all options trading that you want to do on either FAS or FAZ should all be done on the 1X long financial ETF, the XLF, that has the most volume. This is going to have the most volume. It's going to have the tightest spreads. And virtually, if you do a bull call spread on XLF and a bull call spread on FAS, it's the same trade, but one is going to be more expensive to make. All options trading should be done on the XLF. And let's take a look at the last way to use these levered ETFs, and it's a fantastic way to use them as a hedge. They're a great way to delta hedge out exposure in a portfolio. So let's take an example of how a hedge would work. Let's say there was someone who was short $30,000 of financial stocks. So they're maybe short some Goldman Sachs, they're short some Morgan Stanley, they're short some Wells Fargo. And all of a sudden, they see that the market is likely to go higher, and financials are likely to go higher as well. If they don't want to exit their position for some reason, but they don't want to sit through any pain, they can simply go on the other side and hedge this out by buying $10,000 worth of the FAS. Now, at this point, they are effectively hedged. So let's say that the market rallies and cranks up, goes up 10%. That is very detrimental to that 30,000 short financial stock position. Theoretically, that's going to lose about $3,000 if the financials follow what the market did. However, you are long 10,000 of FAS, so that FAS is going to go up around 30%. Again, the differential, it might be 28%. You might get lucky, it might be 31, 32%, but there is going to be a nice gain on that other side. So whatever you lost on one side, you're going to make back pretty much what you lost on the other side. This is a great way to use these. Hedging is a fantastic, fantastic way. Before I let you go here, we got to talk about the number one risk. These things are dangerous, and if you do not position size correctly, I guarantee you that one of these will wipe you out. If you take a look at the returns on these. Now, there was 1 month in there where the FAS went down 30% in a month. If you had your whole entire account in FAS, the position size was too big, that's a big hit. There are some of these ETFs that over a year will go down 96, 97%. If you hold these for too long and they go against you, I have seen people wipe out a $100,000 account to almost zero because they were in one of these levered ETFs, wouldn't take their loss, doubled up on it, and it ended up killing them. So whenever you play these, you must be respectful of them. You must understand that these things can move 10, 20, 30, 40, 50, 70%. And you have to position size for that kind of risk accordingly. So we like trading FAS as an intraday or a swing trade. Like I said, nothing more than 10 to 15 days. All of a sudden, the differentials and the costs really start to eat into that 3-to-1. All options trading, we love options on ETFs, but they should all be done on the 1X long ETF, the XLF in the financial sector. And hedging, we love it for hedging. If you have some positions, even if you have some options positions, you can always use these levered ETFs to quickly hedge out your delta when you want to reduce that exposure. Thank you so much for joining me. This is the Levered ETF series from Maverick Trading. Take care. Goodbye.